Hello and welcome to the next installment of Diversified's Asset Class and Manager Spotlight. My name is Mike Horwath. I'm the Chief Investment Officer here at Diversified Lifelong Advisors. Today we're going to go through growth versus value. So we're going to take a little bit of a detour from talking specific asset classes to talking more styles of investing. These two styles, growth and value, are probably the most popular when spoken about. You may see these styles on the investments in your 401ks or your 403bs, but what do they really mean? So growth investing is the idea of finding companies that are growing faster than the overall market. Historically, these tend to be industries and sectors specifically driven around technology, around healthcare, around communication services. They tend to be reinvesting their earnings. So if you think about big, established, mature companies that have always kicked off dividends, you think of some of the old big names of GE or Johnson & Johnson. These aren't that. These companies are taking their earnings, they're reinvesting them into growth projects. They tend to be more expensive, so a lot of their earnings are expected to be farther out in the spectrum, meaning a company may get their earnings, they may be reinvesting into projects that are expected to pay off down the road. So their earnings are way down the line, and there's several years before those projects or ideas are going to come to fruition. Typically, investors are willing to pay more for that. So that's what I mean by they're more expensive. They tend to be more expensive relative to the earnings of the previous 12 months or the next 12 months. As I said, these tend to be very concentrated into more of the technology, into healthcare. If you think about it, the Apples, the Amazons, the Teslas, these companies are taking their earnings, they're reinvesting into new projects, buying new companies, trying to really grow the firm. Very concentrated index. When you look at the Russell 1000 Growth Index, it is extremely concentrated into technology. On the flip side, when we look at value investing, it's a historically very academically driven style of investing. And it's very intuitive, right? You buy low, you sell high. Oftentimes what you find with this style, though, are you're buying companies that have been out of favor. They've been beaten down for whatever reason. They're usually big, mature companies that are just not growing as fast. They're more stagnant, but they're reliable. They're in industries that are still growing or that are still very viable in the economy. So if you look at the biggest names, you look at JP Morgan Chase, you look at Johnson & Johnson. And I think one thing that's very important to look at is the sector distribution within this style of investing. It's much more diversified. Because they don't have as many projects to grow, what you find is that their dividends or their dividend yield is much higher than growth style investing. When they get their earnings, oftentimes they return those earnings to their owners, right, which are shareholders. So typically they'll be bigger, more mature companies, growing less fast, growing slower, I should say, and they're going to have a higher dividend yield, right? They're going to be much more traditional sectors like financials and energy and things of that nature. So from a return standpoint, what you've noticed over the last decade is the market's been dominated by growth stocks. It's been dominated by the top 5, 10 names in the S&P 500 when I'm talking about the US stock market. Those top names are the Apples, the Amazons, the Googles, the Facebook, Netflix. Those names have dominated the markets over the last 10 years. So growth has really outperformed. When you look at the cyclicality, though, of growth and value and when they perform better or worse, it's interesting to take a look back. That time period after the tech bubble in 99, 2000, 2001, value outperformed from 2000 to 2006 in each of those calendar years. So 7 straight years of value outperformance. If you sat there in 2007, I'm not sure you would have been a very heavy growth investor based upon what the recent performance has been. So this can be very cyclical based upon what's working in markets, the concentration of markets, and other things like interest rates and things of that nature. So which is better? Which makes sense? And I don't think it's a binary question. I know it's not a binary question. I think you can ebb and flow your portfolio and tilt your portfolio to areas that make sense or look like they have better opportunity moving forward. But the case for growth is, well, recent performance is a pretty good indication that it's done very well, right? It's very viable. Everybody knows the big tech names. So growth investing has performed very well. Also, intuitively, technology has become a bigger and bigger part of everything we do, right? If you think about artificial intelligence, you think about robotics, you think about all these different things like electric vehicles and new styles of energy, very technology driven, tend to be more growth oriented. So a lot of opportunity moving forward in those areas. Typically, lower interest rates and lower growth environments are more conducive to growth and style investing as well. A little bit of the in the weeds rationale behind that is, as I said earlier, the earnings for these companies are farther out, right? Rather than more value oriented companies that are bigger, more mature, more stable, their earnings are pretty stable over time. Well, these growth companies have big growth opportunities with earnings way down the line. At lower interest rates, it means that you can discount those future earnings and achieve a higher stock price today, or at least a higher justifiable stock price today. And candidly, growth investing can be a little bit more exciting because you're going to more emerging type of industries. You're buying into companies that are coming to fruition, coming together. They're in their early stages or they're in rapid growth stages. It can be a little bit more exciting. But why value, right? I think one reason is it's academically proven to really perform well over time and add value over time. It's been a style of investing that's been around a long time, right? The old Warren Buffett style of investing is buying big quality companies that are trading at a discount to their intrinsic value, right? It seems so common sense, but it's really what value investing truly is buying companies that are trading cheap relative to their peers, relative to their industry, relative to the market. And it's logical, right? You buy low, you sell high, right? If you buy a stock that's been beaten down, you're ideally trying to wait until it comes to back to its intrinsic value and then reinvest it back into something that's cheap again. I also think it's important to remember that these can be very cyclical, growth versus value. As I mentioned, the early 2000s, just before the financial crisis, value stocks outperformed pretty regularly. Over the last decade, it's been a different story. Growth stocks have really performed well, driven by big technology. It's also interesting from a dividend standpoint, if you need an income yield, value stocks are going to give you higher dividends. And, I think it's worth pointing out as well that the value index is more diversified than the growth index is. If you look at the top 10 names, you look at the top 5 names, you look at the sector distribution, it's much more diversified in the value index than it is in the growth index. That's just the way it's become over the years as big tech has become a bigger and bigger portion from a market capitalization standpoint, bigger portion of the overall market. So how do we at Diversify think about growth versus value? Right now, we're still a little overweight growth. Much of that overweight, though, comes in the way of international investing. We look at international investing, some opportunities, especially within emerging markets, the rise in technology, healthcare affordability, the rise of the middle class in emerging markets. We think that there's a really good opportunity for these growth-oriented companies to really come to fruition, especially within areas like China and India. There's a lot of opportunity from a growth standpoint. Domestically, we still also lean a little bit growth. We still have faith in the big tech names. We still have faith in some of the emerging industries within the U.S. But we have rotated, especially since October before the election, that we started moving a little bit more towards value just to cheapen our portfolio. We saw some opportunities in areas like financials where, while they haven't performed well, banks are very healthy right now. But we think the banking sector is very healthy, and we think financials are a good opportunity. But we are diversified. We're not extremely overweight one or the other. We tilt towards growth. We understand that these things are cyclical. as economic growth picks up, as inflation potentially picks up, as interest rates increase over time, we may rotate a little bit more towards value because those are more types of environments that are conducive to value outperforming. But always recommend to remain diversified and tilt your portfolio to areas where you see opportunity. So I hope you found this valuable in understanding the differences between growth and value. And just as a side note, just so you know, blend or core, so a lot of times you'll see the style of investing listed as core or blend. It just means you're mixing the two together. But growth versus value are good ways to tilt your portfolio. It's a good way to access specific sectors. It's a good way to access specific styles of investing. So really, in summary, we're a little overweight growth today. We have balanced that out over the last 3 to 6 months. But internationally, we do favor more growth-oriented, more technology, healthcare, and communication service-driven companies. But I appreciate you hopping on. I'd love to hear your feedback of this video and of what we're doing here at Diversified. Until next time, until next month, my name is Mike Horwath, Chief Investment Officer at Diversified Lifelong Advisors. Stay healthy, stay wealthy, stay happy. Take care, everybody.